Morning, good afternoon, and good evening to everyone joining us from different parts of the world. Welcome to this webinar on harmful tax practices, first of our series, Four Definitions to Change the World, Struggles Over Meaning in the UN Tax Convention Negotiations. My name is Sergio Chaparro Hernandez, International Policy and Advocacy Lead at the Tax Justice Network, and I have the honor of moderating today's discussion. This session focuses on one of the most politically charged questions in international tax cooperation. When does a country's tax policy stop being a legitimate exercise of sovereignty and become harmful to other countries' ability to tax fairly, raise revenue, and finance development? That question has been present from the early stages of the UN Tax Convention process. In the Bureau's proposal for the zero draft terms of reference, one of the proposed principles recognized that every member state has the sovereign right to decide the policies and practices of its domestic tax system, but also the responsibility to ensure that such policies and practices do not undermine the effectiveness of the tax base or system of other member states. That formulation captured the central tension that still defines this debate. Tax sovereignty and cross-border responsibility must be understood together. The wording changed in the adopted terms of reference, but the underlying concern did not disappear. It resurfaced more explicitly in the Colleagues Draft Framework Convention template of October 2025, discussed at Nairobi, where harmful tax practices appear as a standalone commitment. The text then evolved again in the Colleagues Draft of January 2026, discussed at the fourth session in New York, and the standalone commitment remained, but the article was modified. The earlier reference to minimum taxes on business activities was removed, and the draft instead focused on cooperation to identify and deter harmful tax practices, enhance transparency, monitoring and identifying emerging harmful tax practices, and the effective taxation of economic activities that benefit from such practices. The latest Intergovernmental Committee discussion in New York in February this year showed that Article 8 remains highly contested. Delegations broadly split between those calling for stronger operational ambition, including clearer definitions, monitoring implementation tools, and in some cases minimum rate language, and thus urging flexibility, non-duplication with existing fora, and safeguards for domestic policy space. Non-state stakeholders also pushed the debate further, stressing that harmful tax practices undermine revenue for development, public services, climate action, and human rights, and warning that existing standards and blacklisting practices have often been applied asymmetrically against poorer and less powerful jurisdictions. So Article 8 on harmful tax practice is not a technical footnote. It is one of the places where the convention must decide what tax sovereignty means in an interdependent world. Whether sovereignty means only the freedom to design domestic tax policy or also a responsibility not to erode the tax base of others. But there is also a second equally important problem. Who has the power to define harm in the first place? Existing standards on harmful tax practices have often been developed in governance spaces where many developing countries, small states, and formerly colonized jurisdictions have had limited voice, while still being expected to comply with rules designed elsewhere. This lack of inclusivity has not only affected the legitimacy of the standards, it has also shaped their substance. Practices considered harmful have often been those that threaten the tax bases or policy preferences of powerful countries based on subjective criteria, while regimes, incentives, and enabling structures embedded in those same powerful economies have often been treated more leniently. The politics of blacklisting illustrates this problem clearly. Current listing practices often single out selected jurisdictions while leaving outside equivalent scrutiny many of the actors and structures that play a central role in enabling global tax abuse. More objective criteria, such as financial secrecy risk, corporate tax haven exposure, and effective tax rates, point to a broader and more systemic distribution of responsibility. Indices such as Tax Justice Network Financial Secrecy Index and Corporate Tax Haven Index show that harmful tax practices are not confined to smaller, political weaker jurisdictions. They are also embedded in major financial centers, advanced economies, and jurisdictions closely connected to powerful states. The problem, therefore, is not only methodological, but deeply political. Current governance arrangements can reproduce a colonial dynamic in which some countries define the standards, judge others against them, and attach reputational or economic consequences while not always being subject to the same level of scrutiny themselves. A genuinely universal framework should instead assess all jurisdictions against common transparent and evidence-based criteria, for instance, via info on effective tax rates via country-by-country reporting, public country-by-country reporting. So that responsibility is identified where harmful tax practices are actually enabled. This is why the UN Tax Convention matters. It offers a chance to move from selective and exclusionary forms of discipline toward a genuinely universal framework, one in which all countries participate in defining harmful tax practices. All countries can be assessed against common principles, and the focus shifts from protecting the tax base of the powerful to protecting the fiscal sovereignty of all. The limits of existing frameworks are also visible in the evolution of tax competition itself. An IMF analysis gives us a stark before and after picture. In 2006, when the Forum of Harmful Tax Practice concluded its work on harmful preferential tax regimes, the average statutory corporate tax rate in OECD countries stood at 27.1%. At that time, there were perhaps only 2 or 3 intellectual property box regimes. By 2020, after the BEPS agenda, the average OECD statutory corporate tax rate was 23%. Now it's closer to 21%, while the number of compliant intellectual property box regimes had expanded to more than 80, including regimes offering tax rates of 5% or lower. Other non-IP regimes, including headquarters and financing regimes, also remain in place. This evidence tells us something important. The OECD framework might have constrained some of the most artificial or non-transparent forms of preferential taxation, but it did not end harmful tax competition. In many cases, it made tax competition more formal, more substance-based, and more compliant with exclusionary standards, but not necessarily less harmful in terms of foregone tax global revenue. The concrete example of patent box regimes help us to show why this matters. Patent boxes, also known as IP boxes, intellectual property boxes, or innovation boxes, allow companies to pay a reduced tax rate income derived from patents or other qualifying intellectual property. These regimes are profits-based incentives because they reduce tax on profits after those profits arise, unlike cost-based incentives such as R&D credits or investment allowances, which are linked to actual expenditure. The distinction matters because profit-based incentives can reward income after the fact, create windfall gains, and generate less predictable revenue costs. The OECD modified Nexus approach was meant to address part of this problem by linking benefits from IP regimes to qualifying research and development expenditure. But the deeper question remains, does formal compliance actually eliminate harm, or does it simply make preferential regimes acceptable under a narrow standard? And the same question now arises in relation to the implementation of Pillar 2, the global minimum tax. There is intense debate about how tools such as qualified refundable tax credits, or QRTCs, can be used strategically to preserve low effective taxation even under the new minimum tax framework. In other words, harmful tax practices are not only a legacy issue from the pre-BEPS era, they are constantly adapting to new rules. Even a global minimum tax can be strategically navigated if the framework does not address the design of tax credits, effective tax rates, substance rules, and the real distribution of taxing rights and power asymmetries. So the question, conclude this introduction for Article 8, is not simply whether tax incentives are good or bad. The question is how the UN Convention can distinguish legitimate policy space from harmful spillovers, how it can build on existing work without reproducing its blind spots, and how it can create a framework that is more inclusive, more effective, and more responsive to the realities of countries whose tax bases have often been most vulnerable to decisions taken elsewhere. To help us navigate these and other questions, we are honored to have an excellent panel. First, we will hear from Professor Dr. Stephen Dean, Professor of Law, and Paul Siskind, Research Scholar at Boston University. Professor Dean's work has been central to exposing structural inequalities in the international tax system. We will then hear from Ms. Marlene Nembar Parker, Deputy Commissioner General at Tax Administration, Jamaica's Legal Service Division, colleague of working team on prevention and resolution of tax disputes, and main delegate for Jamaica at the UN tax negotiations. Finally, we will hear from Senator and Attorney General Leo Ryan Pinder from the Office of the Attorney General and Ministry of Legal Affairs of the Bahamas, who will bring an important perspective from a jurisdiction deeply engaged in debates on international tax standard setting, sovereignty, and fairness. Each speaker will have around 15 minutes. And as speakers, you are welcome to touch upon one or more of the following questions in your presentations. Who should define harm? How to distinguish between legitimate and harmful tax competition? Is blacklisting fit for purpose? Is a static definition or a dynamic definition on harmful tax practice required? What should be done about existing standards? How to operationalize Article 8? And how to treat tax incentives within that article, for instance. After that, we will move into a moderated discussion and then open floor to questions from the audience. You will see that there is the chat function to ask questions. And if sorry to forget to say this from the very beginning, we also have interpretation to Spanish available. También tenemos interpretación al español disponible en la parte de abajo de sus pantallas. With that, it is now my great privilege to invite Professor Stephen Dean to take the floor. Professor Dean, the floor is yours, please.
Thank you so much, Sergio. Really appreciate the opportunity to be here today with all of you. Exciting to see so many people in the chat from all over the world. It's really exciting in this space, international tax, to see so many voices and kinds of people involved and engaged. That has not been the history of international tax policy, as I will explain briefly, and I'll explain why it's so important, that you're here. And just grateful to the Tax Justice Network for having been on the forefront of these issues for so long and still fighting, keeping everything as it should be. So I'm going to share some slides, and I will just say the one other fact that I should mention, other than where I work now, is that I am originally from the Bahamas. So my perspective on these issues is not unrelated to that fact. So keep that in mind as I talk about some of my work. So I'm talking about work that I've done over the years, but especially a book that just came out last year that is Racial Capitalism and International Tax Law, the Story of Global Jim Crow, which really tries to tell the story of how we got here. And I'm not going to tell the whole story. You know, the book is out there. You can read the whole thing if you want, or follow up with questions anytime. But I'm just going to give you a little bit of a snapshot that really, I think, illustrates the danger in this definition and how it may go awry. All right. So what are harmful tax practices? You know, I don't know how many of you guys are tax experts, but many of you may have heard of this specific tax structure, this form of tax abuse. So Google set up what was called the double Irish Dutch sandwich. And this was essentially a way of moving, Apple used this as well, famously. This was a way of shifting income from where it was earned, say in Europe, continental Europe, to Ireland. So it would not be taxed. And so this was a problem. This became a problem, you know, over the last few decades. But this is the classic corporate tax abuse structure. And what's so fascinating about the history of all this, from my perspective, is that this problem is not a new one. This is a problem that President Kennedy described in the early 1960s. So he explained that multinationals had begun forming foreign subsidiaries, and they were going to exploit foreign tax systems, international tax agreements in order to reduce or sharply eliminate their tax liabilities, which is exactly what Google and Apple were doing with the double Irish Dutch sandwich. And I guess the question is, if Kennedy knew about this at the time, why wasn't the problem solved and addressed then? Why did it linger? And not only did it linger, this is a chart that I've stolen from the U.S. Treasury Department, and this is just showing U.S. This is just U.S. U.S. corporate income tax receipts as a share of federal tax revenues from a little bit before Kennedy was angrily writing about this problem to a little after 2000. And I'll have another chart that's a little more current later. But I just like this chart because it really is, if you were, making a movie and you wanted to show bad things happening, right? This might be a chart that you might take out of the prop room and throw up on the screen. This is bad, right? Why is it so bad? And again, it's not because the U.S. didn't know what the problem was, but corporate tax receipts were just falling throughout this period, even when we knew what the problem was. And the problem was transactions like Google and Apple's double Irish Dutch sandwich. Why not? There were a few reasons why not. Corporations obviously liked abusing using the corporate income tax. They really liked forming subsidiaries overseas to limit their tax payments. So President Kennedy's, this is a little too inside baseball, but I can't help myself. Um, President Kennedy's chief tax advisor was this Harvard professor known as Stanley Surrey. And he has a long history in international tax policy, but just this one story. So he was the one who was telling Kennedy what was wrong. He's the reason that Kennedy knew about these sort of proto double Irish Dutch sandwiches. And the resistance from corporate America was so strong that he ended up writing, and I've seen the letters in his papers in the Harvard Rare Book Library. All these letters he wrote to corporate executives, just basically apologizing for threatening their ability to engage in corporate tax abuse. So they really dialed down their approach. They ultimately produced what we know as Subpart F here in the U.S. Controlled foreign corporation regimes is really what came out of this ultimately, rather than a fix to the underlying problems. Another problem, and this goes to what Sergio was highlighting, the jurisdiction that Kennedy was complaining about was 100% clear. They were not talking about the Bahamas or any other island. They were talking about Switzerland. Surrey and his team were laser focused on Switzerland. In fact, they were so laser focused on Switzerland that the Swiss Attorney General threatened threatened prosecutions. So it really was more dramatic than you might expect. And of course, this is a time when the U.S. needed Switzerland badly, right? This is around when the Cuban Missile Crisis was happening. The U.S. didn't have diplomatic relations with Cuba. Switzerland was our diplomatic relation with Cuba. The last thing the U.S. was going to do was make Switzerland so angry that it was going to prosecute them for just some harmless corporate tax abuse. So we allowed this to go on for years. Not only do we allow it to go on, but you'll note in that quote from Kennedy that he specifically talked about international agreements. These are double tax treaties that are the core of a lot of corporate tax abuse. And around when Kennedy complained about them, there were not that many. He complained about them, and we got thousands of them. So it's really not surprising. Again, these charts that I'm showing you, they're not very subtle, but they really do capture what is happening and what has happened. So this is just a follow-up to that earlier chart about U.S. corporate tax receipts. So this goes out a little further to 2022, but you see the same pattern. You see that the individual income tax was going up, sort of supplementing for what the U.S. was losing from its corporate income tax, which of course is part of the reason that rich countries were comfortable with the with corporate tax abuse. They had other sources of revenue, especially the individual income tax. Of course, developing countries rely more heavily on the corporate income tax than rich countries do. So this is all part of this really not great set of facts with rich countries understanding the problem, identifying it, complaining about it, but not having the political will to challenge it because their friends were the ones who were helping make it happen, and corporations that were very influential were the ones who were enjoying the fruits of it. So where does that leave us? So this continued on, and in the years before we got the outrage about the double Irish Dutch sandwiches, the organization that had been in charge of global tax policy since shortly around when Kennedy complained, so formed in 1960, the Organization for Economic Cooperation and Development, had been sort of the leading voice on global tax policy for many decades, still is in many ways. They were essentially asked, "Hey guys, what is going on? Why can we not tax anyone? You guys have been in charge of this for many years. Why is it working so poorly?" And the OECD thought for a year or two, and they decided, and I wish I were making this up, but I'm not. They decided essentially that the problem was Liberia. So they issued a blacklist in 2000 that included these jurisdictions. This is a New York Times article discussing the blacklist, and you can see that the none of the none of the countries jurisdictions on this list were Switzerland, even though as far back as Kennedy, everybody knew that was the place where a lot of this abuse was happening. So how do we get here? How do we get to a situation where Liberia was named a tax haven at this time and threatened with economic sanctions? Um, the the OECD had come up with apparently objective criteria of what a tax haven was, and they were a little bit confused. It wasn't quite clear whether they're talking about individual tax havens where a rich criminal might hide money, or whether they're talking about corporate tax abuse. But they came up with a an objective definition, if it was even if it was a little bit ambiguous, and they basically looked for countries that had no income tax, no or low income tax, weren't sharing information, and a few other criteria. Just had a bad reputation was one of them as well. And of course, at this time in 2000, Liberia did not satisfy the criteria, or did satisfy the criteria that the OECD had laid out. Not because it was really doing anything. Well, it was doing things wrong. This is in the middle of what was either the second civil war in short succession or a continuation of the first. The fact they did not have an income tax was not a sign of abusive behavior. It was a sign of a country in crisis, and that was what the objective criteria drawn up in Paris at the OECD headquarters at the Chateau de la Mouette. That's what they decided that a country that was a tax haven looked like, but it was really a country in crisis, and they were threatening to impose sanctions on this country crisis, which is really, really incredible to realize. So, seemingly objective criteria, but producing a result that was obviously absurd. And where does that bring us to today? So, sort of the current version of listing Liberia as a tax haven. And again, I mentioned I'm from the Bahamas, so I like palm trees and coconut trees. Make me feel very at home. This one did not. This one actually is from, I'll show you where this is from. This is from the OECD's 2021 brochure explaining its two pillars. So it presented its pillar two as its global minimum tax as a response to the problem. Of course, the problem is the same one Kennedy identified years before. Companies using treaties to move money to countries like Switzerland and Ireland, a double Irish Dutch sandwich. No tropical islands named in that transaction for good reason. But they presented in this brochure their sort of distilled image of what their minimum tax was. And they had not one coconut tree, but two. And of course, I, as a connoisseur of coconut trees, I just like that. And I'll move back to this so you can see it closely. Right. Those of you who are from places with actual coconut trees know that when coconuts grow on trees, they do not look like this. These are grocery store coconuts on a coconut tree on a tropical island with rays of sun, stacks of cash. This is not at all what corporate tax abuse is about, but this is how they're presenting what corporate tax abuse is, why they have these pillars, why they have this global minimum tax. They're essentially saying, and this has been their narrative the entire time, the OECD has presented themselves as sort of a beacon of progress and enlightenment that is sort of under threat by dark forces. And those dark forces are islands like the one I grew up in. And it's really just pretty incredible to realize. I'm going to wrap up in just a minute. I know I'm running low on time. and it's just important to understand how we got here, right? So how do we get here? So this collection of countries, right? These are the original founding countries of the OECD. It's just not really surprising that they would do the sort of do the work that they did in the way that they did it. Right, these are all the countries that are not part of the OECD. That is a lot of countries. Some of you may be in one of them right now, but that is really the problem, and that to me is why it's so important that all of you are here today, and why it's so important that what is happening at the United Nations is happening, because it's really essential to avoid, you know, purportedly objective tax haven definitions, having sanctions imposed on countries like Liberia in the middle of the Civil War, having coconut trees being issued in a brochure explaining why we need corporate tax, global tax reform. It's really time that we did a better job, and I'm happy to see that happening and optimistic about what's happening at the UN. I will end there. If you have any questions, that's the book that came out last year. And if you have any questions, that's my email address. You are more than welcome to email me at Boston University. And with that, I will close. Thank you, everybody, for being here today.
Thank you very much, Professor Dean, for that powerful, really an thought-provoking intervention. You have helped us to situate harmful tax practice standards as part of a broader history of international dominance and racial injustice, one that reflects deep asymmetries in who writes the rules, who benefits from them, and who absorbs also the revenue losses or the reputational damage. Um, I now have the pleasure of inviting Ms. Marlene Nembar Parker to share her reflections. Marlene, the floor is yours, please, for 15 minutes.
Okay, thank you very much, Sergio. I hope you're hearing me. Just confirm whether or not. Okay, great, great. And just want to say thanks to Tax Justice Network for the invitation to speak. I think on one of the most important and probably will become controversial areas of the work on the Framework Convention, Article 8, which deals with the issue of harmful tax practices. My approach today will be confined to looking at what we currently have in terms of the definition from the Forum for Harmful Tax Practices, and then to look at the wording that has been proposed in Article 8 of the Framework Convention, and to do a comparison between the two. I am mindful, Sergio, of the questions that you asked us to focus on, and I'm hoping that in the presentation, I'll be able to address some of those issues. And so perhaps we could start by looking at the fact that the FHTP has been around long before the BEPS project. From 1998, they have been trying to conduct reviews of preferential tax regimes since 1998 in order to determine if the regimes could be harmful to the tax base of other jurisdictions. And so that basically has been the objective of the Forum for Harmful Tax Practices. This is done, the current work is done by the assessment of preferential tax regime to identify features of those regimes that can facilitate base erosion and profit shifting and have the potential to unfairly impact the tax base of other jurisdictions. Secondly, the peer review system and the monitoring of the Action 5 transparency framework through compulsory spontaneous exchange of relevant information on taxpayer-specific rulings, which in the absence of such information could give rise to BEPS concerns. And thirdly, the review of substantial activities requirements. It should be noted that the FHTP framework on harmful tax practices is also supported by other mechanisms. So the OECD also has the CRS, exchange of information, which promotes transparency to prevent tax avoidance through concealment of ownership and assets. There are the transfer pricing guidelines, which ensure prices for cross-border transactions reflect the arm's length values to prevent shifting of profits. The substance requirements requiring actual economic activity, employees, and investment in the jurisdiction to justify tax benefits. There are the GART measures, the general avoidance measures, or specific anti-avoidance provisions to counter tax avoidance schemes, the blacklisting and the gray listing of the mechanisms in the OECD context where jurisdictions are identified which are considered to be harmful, and there's an application of coordinated sanctions or pressure to reform. And of course, there is the BEPS, the Base Erosion and Profit Shifting Project, a comprehensive framework with actions that members and partner countries implement to curb tax avoidance strategies. So the current environment, which is the FHTP regime and its monitoring process, is supported by a slew of other mechanisms, all intended to deal with the issue of harmful tax practices. The core definition at this work by the FHTP is, in brief, a definition that states that a harmful tax practice is a tax regime or regime feature that provides profits to be earned from mobile activities such as manufacturing, trade, services, or IP, with little or no corresponding economic substance in the jurisdiction offering the regime. In other words, the regimes that create BEPS incentives by shifting profits without substantial real activity. The key characteristics of that definition signal that there is harm, there is a preferential or zero or nominal tax rates or regimes that effectively permit profits to be taxed at very low rates. The tax regime attracts profits without genuine economic activity. Example, profits from IP, services, or manufacturing generated without substantial staff, lack of transparency or information exchange that impedes scrutiny, mismatch with economic substance and regimes that entice profits from mobile activities, and regimes that are easily abused for treaty shopping or routine profits. So that in a nutshell, is what currently exists. Now, why have I focused on the current the current definition that is a working definition for harmful tax practices? Because the comparison has to be drawn with what has been put forward with Article 8 in the Framework Convention. And so I'm going to look at Article 8, and then I'm going to compare the two definitions. There are, in addition to Article 8, there are countries that have also put forward their own wording, and this is, of course, in the cut and thrust of the negotiations that are going on, particularly the African Union, India, and Norway. I won't go too much into that, but what I would want to focus on is the distinctions between what currently exists and what is attempted in Article 8 in the Framework Convention. And so if we look at the what has been put forward in Article 8 of the draft text, it states that the state parties shall cooperate at international and regional levels to identify and deter harmful tax practices, to neutralize their distortive effects, and enhance the ability of all countries to tax income in accordance with their domestic laws and policies. And that is paragraph 1. Paragraph 2 states that the state parties shall develop, enhance, and implement effective tools to address harmful tax practices, including tools that provide for A, enhanced transparency, B, monitoring and identifying emerging harmful tax practices, and C, the effective taxation of economic activities that benefit from harmful tax practices. So, in Article 8, the essence of Article 8 is the highlights what is the purpose. And the purpose is of Article and focus of Article 8 focuses on international and regional cooperation to identify, deter, and neutralize harmful tax practices with an emphasis on enabling all countries to tax income in line with their laws and practices. However, there is no definition as such in Article 8. The core definition that arises, however, from the language in Article 8 is that there is a focus on what constitutes a harmful tax practice itself. Well, it assumes that there will be a core definition. That definition has not been outlined in Article 8, right? But it assumes that there is a definition of a harmful tax practice. What Article 8 does is to go into the ways in which there can be cooperation that can neutralize harmful tax practices, and that can be done by cooperation between the state parties. In terms of the FHTP definition, that focus is on what constitutes a harmful tax practice, namely regimes that shift profits from mobile activities to jurisdictions with little or no substance, creating BEPS incentives. Let us look at the scope of the action. Article 8 covers cooperation, transparency, monitoring, and use of tools to address harmful tax practices. In fact, it is process-led and instrument-oriented. So what will the parties do and how will they do it? If we compare that with the FHTP definition, it is more substance-oriented, defining the target of the concern, the characteristics of the regime, rather than the methods to combat it. Another distinction is who is in scope, who is responsible. Article 8 specifies that the state parties acting at international and regional levels, and it emphasizes collaboration and shared tools among those state parties. In the current regime under the FHTP, the core definition operates at the level of defining what constitutes a harmful practice, and it's applicable to any jurisdiction recognizing that definition. Let us look at the mechanisms and the tools that are outlined in both definitions. Article 8 lists concrete mechanisms such as enhanced transparency, monitoring for emerging harmful tax practices, and ensuring taxation of activities benefiting from those practices. The core definition does not specify tools or mechanism. It simply provides diagnostic criteria for what is considered harm. Article 8 addresses ongoing identification, deterrence, and neutralization of practices over time. It speaks about emerging practices, and it implies a dynamic and a kind of evolutionary process. The core mechanism is a static list of what constitutes harmful tax practice, substance, whether or not there is substance, for example. In terms of the substance and versus the policy alignment, Article 8 aims to align international practices with domestic tax policies by enabling the states to tax in accordance with their laws, their domestic laws, and it emphasizes collaboration across the state parties to close the gaps across those jurisdictions. The core definition, however, emphasizes the economic substance tests, which are profits from mobile activities without any real activity. What are the potential gaps, therefore, right, that we need to compare between what currently exists, substance-oriented, a set of mechanisms that are applied in order to bring countries in line with the substance test. And as I said before, the current definition of harmful tax practices is also bolstered and supported by other initiatives within the OECD, such as the transparency tools. It is also boosted by the general anti-avoidance test that has been put out by the OECD, the CRS, the Common Reporting Standards, and other measures, as I mentioned before. Article 8, in terms of what are the potential gaps, Article 8 relies on member cooperation and tools. Its effectiveness depends on consistent application of the core criteria across jurisdiction, whereas the core definition, the FHTP definition, provides a threshold for identifying harm, but it does not itself specify enforcement, remedies, or governance processes, all of which Article 8 seeks to address through coordination and tools. On the issue of complementarity, the core definition functions as a foundational standard that Article 8 can operationalize. Article 8 outlines how to work together to detect, monitor, and tax regimes that meet the core definition of harmful. That is one of the ways in which the two can work together. However, there are points for concern. For example, Article 8 assumes harmonization of objectives, but differing national interpretations of what is substance, what is a mobile activity, as well as the BEPS incentives could affect a consistent application of Article 8. Article 8 proposes tools such as transparency, monitoring, and taxations, which must be compatible with what is to be what we hope a definition in Article 8. And so that what I've tried to do is, because we are discussing here what should a definition in Article 8 look like. I will just summarize by saying that currently Article 8 does not have a definition. What they are advocating is that there should be cooperation among the state parties, that the state parties should rely on their domestic law. They also mention the fact that there should be tax transparency, and it is assumed that when they speak about tax transparency, they are speaking about the exchange of information among jurisdictions. And so reliance is placed on the jurisdictions themselves to monitor themselves, to bring about a situation where their practices and their policies do not cause harm to other jurisdictions. And so I will stop there for the moment. And I hope that in drawing the distinction between what is current and what Article 8 seeks to do, I would have answered some of the questions that you have asked us to address.
Thank you very much, Marlene, for such a rich and grounded contribution. You have brought into the conversation a crucial perspective, the essence and potential gaps of the current text, the implications of having or not a specific definition, the substance test as a core pillar of existing approaches, the interaction of sovereign decisions with international standards, and the need for rules that are not only principled but workable for countries with very different enforcement capacities and institutional contexts. I now have the pleasure of inviting Senator and Attorney General from the Bahamas, Leo Ryan Pinder, to take the floor for 15 minutes. Senator, the floor is yours.
Thank you, Sergio. I appreciate that. And thank you for the contributions from Professor Dean and Marlene. I should clarify one thing. We've had elections in the Bahamas 2 weeks ago. The governing party did win, so that is good news. However, I have re-entered private practice as an international tax advisor and commercial attorney, but I will be advising the government of the Bahamas with respect to the UN Tax Convention and probably attending up in New York for further negotiations. I wanted to kind of structure my brief contribution really to talk about a couple of things. The first one would be how the harmful tax practice initiative of the OECD was really one of the core predicates to the advocacy at the United Nations, and how the approach by the OECD with respect to harmful tax practices really created the international outrage of inequality of the OECD and why we're at the United Nations. Then I'll raise a couple of points about Article 8 and where I think we are in the negotiations of the convention, and where I think Article 8 certainly can be improved. And then I will discuss how some of the OECD double standards that have existed with respect to their member countries really in and of itself is a harmful tax practice and really should be condemned. And then I'll conclude, hopefully, just addressing some of the questions. So the OECD's inclusive framework developed BEPS Action 5 and released some global standards that we know that apply to no or only nominal tax jurisdictions. So these determinations only apply to countries who have, under the OECD standard, no or a nominal tax. And that, as Marlene said, now required substantial activities in order for the tax regime not to be considered a harmful tax practice. And so in and of itself, the approach was clearly inequitable and treated different countries differently based upon an interpretation of what a no or nominal tax jurisdiction was. And that was the definition of what was harmful. Countries like the Bahamas, for example, we don't have an income tax, and therefore automatically we were determined to be harmful because of that. However, we do have a series of other tax. We have a gross revenue tax, for example, that we call a business license tax that in many situations may be a higher tax on income than a straight corporate income tax. But of course, that was not recognized by the OECD, and therefore we were regarded as harmful. We and a lot of other small jurisdictions in the Caribbean and in the Pacific agreed to be part of the harmful tax initiative of the OECD, but only on the basis that there was a level playing field. And that's what we expected. And I think that's what was put forward at the OECD at the time of our participation. Unfortunately, OECD members are the ones that universally set the rules of the game. Certainly, even in the inclusive framework, which really isn't that inclusive. You know, countries, non-member countries, had to one, agree to the rules of BEPS before even being part of the inclusive framework, and then pay a fee, and then really have no input on the outcome. And so there was really no inclusivity. The rules that the OECD put in place as part of the harmful tax practices initiative sought to change domestic tax systems. That's really what their goal was. And administration in the face of sanctions from rich and powerful countries. And those sanctions, as you had mentioned, took the form of unilateral blacklisting. Unilateral blacklisting that really was only imposed against non-member countries and really not a sanction factor of OECD member countries. We heard, as a result of this, a lot of commentary on level playing field and the inequitable treatment of members versus non-members of the OECD. We would know Sir Roland Saunders, certainly a learned Caribbean diplomat, published in a paper entitled "The Fight Against Fiscal Colonialism, the OECD and Small Countries, Assessing the OECD Harmful Tax Competition Initiative." He stated in that paper, and I'll quote him, says, "What is certain is that the principle of multilateralism was dealt a massive blow by the OECD's failure to consult meaningfully with smaller jurisdictions, and undesirable precedents may have been set not only for the future international tax setting and compliance, but internationalism itself." This was published by Sir Roland Saunders back in 2002. And that theory was prolific in the OECD and their approach to harmful tax practices and their approach to countries who, in their view, had no or nominal tax regimes, which by definition from the OECD were harmful. These are really inherent reasons why countries like the Bahamas and the Global South advocated so strongly for the approach to international taxation through the United Nations, hopefully ensuring that the level playing field would exist in the United Nations setting that clearly did not exist in the OECD setting through the Harmful Tax Initiatives program. This, in theory, was rational. It was a rational position to take for non-member countries to say that we look for a level playing field at the United Nations. But in practice, we have seen this throughout the negotiations of the terms of reference, but more so in the recent negotiations of the convention and the two protocols, an unbalanced approach. And sometimes concerted action by OECD member countries and countries of the global north to influence and convince softening of the approach that we originally advocated for when we wanted to go to the United Nations. This, coupled with the abandonment of the process by the United States, in my opinion, has seen the convention get watered down. And the application of the convention get watered down, and is not consistent with with the reform in tax regulation that we intended when we advocated so strongly for United Nations intervention. And I think this is especially true in the approach we are seeing to the article dealing with harmful tax practices. I think Marlene has made the point that this is a controversial element of the tax negotiations. You have very strong opinions from different sectors within the United Nations, from OECD member countries, global North countries, certainly the African group, and frankly, I think small island states who are international financial centers have an even different approach with respect to how Article 8 and harmful tax practices is being developed within the Framework Convention. In my opinion, when we look at Article 8, we certainly are very pleased that coming out of the zero draft, the provision about minimum tax has been removed. The Bahamas, in its commentary, was very strong on that basis. We thought that any position of minimum tax was wrong in that, and it really aligned what Article 8 in the zero draft with really the approach of the OECD, that if you were a known or nominal tax jurisdiction by somebody's definition, certainly not our own, then you were by definition harmful. And that is really, as I have said in the introduction, the predicate of why we are at the United Nations. So to see that in the original Article 8 was very disconcerting for countries like the Bahamas. But we believe that Article 8 should better define what a harmful tax practice is. Without a proper definition, or at least a parameters that define how you determine something to be harmful within the convention itself, you're now leaving the entire process of harmful tax practices up to future debate and up to some unknown body at this time coming up with a definition. And as I have said, we have seen the influence of the global North and OECD member countries over the last couple of years have an influence on the advocacy of the Global Tax Convention. So that's not something that the Bahamas is comfortable with. We would like to see in Article 8 more definition of what is harmful. We think that's very important for us. The language, as I said, seems to model a little bit after the OECD harmful tax practices, and we think that this is an opportunity for the tax convention to really differentiate its approach from the approach that the OECD has undertaken. And as I said, the approach of the OECD was the predicate for us coming to the United Nations. The inequitable treatment of nominal tax jurisdictions by being, as defined by the OECD, as harmful, I think, is one area that the tax convention in Article 8 could really differentiate itself. Harmful tax practices are not by definition having nominal or a different tax regime that is not a corporate income tax regime. And I think that's a very important context with respect to harmful tax practices in Article 8. We don't think it's fair to have a framework that treats certain countries differently and automatically characterizes them as harmful because of their sovereign choice on how they put their taxing regime domestically in place. And this is important, like I said, where we can differentiate ourselves. The absence of this type of language, and really the absence of who is the party who defines what is harmful in the tax convention, really leaves, in my opinion, too many gaps into Article 8, and too much room for discourse and disagreement. We really need to buckle down and think about, how do you define harmful, and who is the party that will define harmful? If you just leave it up to the state parties, we're just going to witness more and more debate, as we've witnessed over the last few years with respect to the tax convention. And so I think those are some important observations with respect to Article 8. The last point I wanted to touch on, before I just mentioned briefly a couple of the questions you raised, is the proposition that the OECD's double standard, in how it treats member countries historically versus non-member countries, is itself a harmful tax practice. We have seen, when we came down to the common reporting standard, for example, that there were variations that were accepted by the OECD with respect to FATCA, and how FATCA is different from CRS, which created tax arbitrage in favor of the United States. And we saw a lot of capital flow into the United States as a result of this tax arbitrage. We see that the regimes of beneficial ownership disclosure and collection, with respect to anti-money laundering and tax transparency, has clearly created a harmful tax practice, in that countries like the United States and their banking institutions don't even collect beneficial ownership information, when countries like the Bahamas have been collecting beneficial ownership information to be compliant with international standards for many, many years. And frankly, we've seen this continue with respect to the discussions now on Pillar 2, on the corporate income tax, the universal corporate income tax, in which the OECD is now developing exemptions to create non-universal compliance with Pillar 2, exempting out certain provisions for some of their member countries, while imposing on countries like the Bahamas the obligation to fully implement Pillar 2, again creating a tax arbitrage in favor of their members. This goes back to Professor Dean's point, that really a lot of the harmful tax practices are originating from within OECD member states, and not countries like the Bahamas and Jamaica. Ultimately, the countries of the Global South pay the price for these double standards, which are universally accepted to be between OECD and its own members, and not accepted for countries that are non-members. I'll give you one example. We started this whole discussion on harmful tax practices, that countries with nominal or no income tax regimes are by definition harmful when it comes to the OECD's position. Well, then I query, since we have been forced to put in Pillar 2, which is a minimum corporate income tax, are we now by definition no longer harmful and exempt from BEPS? Or are we still harmful because we have still a domestic gross revenue tax? And that's a query that the OECD seems to refuse to answer. Certainly, we would take the position that if we're forced to put in a Pillar 2 corporate income tax regime, we're no longer a harmful jurisdiction by the OECD standards, and then BEPS should not apply to us, just like it doesn't apply to its own members. Or is this an example of a compounded double standard that exists when it comes to harmful tax practices? These are some of the issues that I think the convention should be addressing when it comes to what a harmful tax practice is. At a minimum, the requirements and assessment should be according to universal rules that respect domestic tax policy and domestic tax choices. We go back to this gross revenue tax that, for instance, the Bahamas has. It's not an income tax and therefore is OECD harmful. We have studies that would show that our gross revenue tax is actually higher than any minimum standard that the OECD would like to see when you apply it on a net income basis. But again, there's no respect for our domestic tax policy choices. It's a standard that is set by somebody else that we're expected to follow. And I think I had said in the beginning, these are standards that are designed to force countries like the Bahamas to change their local tax administration policies and utilize unilateral enforcement mechanisms such as blacklistings to cause that to happen. Certainly, I think the Bahamas has been on the record many, many times in many, many forums on our patent objection to the use of blacklists and unilateral sanction methodology by the OECD and its member states. We certainly believe that there should be some sort of dispute resolution process instead of any kind of unilateral sanctions. And then I think that the last point I wanted, question I want to address, I think my time is almost up, has to do with the concept of tax incentives, because I think that's an important context and concept that has been raised by the Tax Justice Network and others. And how does this factor into a harmful tax practice? And what are the rights and obligations of countries with respect to tax incentives? Are tax incentives harmful? I say they are not. I say that tax competition is valid. Tax competition between states is fair and reasonable. And in fact, when you really boil it down to the real analytics, and I think Professor Dean pointed this out in his contribution, is that really OECD member states are the kings of tax competition. They're the ones who formulate these opportunities, these loopholes, and these gaps to allow tax competition to occur internationally. And we've seen that being taken advantage of in OECD member states themselves. So when you talk about tax incentives, and especially for small countries like the Bahamas with small economies, is very important component of us attracting capital, attracting business and economic growth. Is for us to have an effective tax incentive regime. Countries like the Bahamas don't produce anything. We don't create anything. We are entirely a services-based economy. We are heavily dependent on foreign direct investment to keep our economy afloat, to keep our people employed, and to create a viable middle class in our society. And therefore, we believe that utilizing properly constructed tax incentives are a fair competition, tax competition element for the countries like the Bahamas to take advantage of, and we do not believe it's a harmful tax practice. I think that's my 15 minutes, Sergio. I want to thank everybody for the opportunity to bring these remarks. I want to thank the Tax Justice Network for allowing this webinar and to hear a kind of fair and balanced opinion on where we are with respect to harmful tax practices, UN Convention, and the OECD's treatment of countries like the Bahamas. Thank you, Sergio. I appreciate it.
Thank you very much, Ryan. You have outlined very clearly the rationale on why, in this specific issue of harmful tax practice, a majority of countries, mostly from the Global South, look at the UN Tax Convention as a way to overcome some of the limitations of current standards, contrary to what we have heard from Global North countries in the negotiations, where they insist on the non-duplication argument and some of them in the possibility of doing fixes within the current frameworks. And we have now heard three rich and complementary perspectives on the structural and historical dimensions of harmful tax practice standards, one on an in-depth comparison between existing standards and the add value and limitations of the current draft text, and one on sovereignty, legitimacy, and lack of fairness and persistence of double standards in current international standard setting, as well as on the implications for the debates on the value of existing standards and the current text. So while I would like to encourage our audience to ask questions in the webinar chat, please. But while we do that, I would like to open with a couple of questions for like triggering the debate and the conversation around us. The first question has to do with how to distinguish between legitimate and harmful tax competition with the opportunity that a universal forum opens. where to draw the line. It's a substance-based test. Now that we have looked at the pitfalls of substance requirements, for instance, regarding IP in the OECD approach, and taking into account that, for instance, some authors propose to see the future of this debate through the lens of a tax trilemma, which posits that governments can only achieve two of three goals simultaneously, like globalization in terms of free trade and capital flows, sovereignty in terms of independent and a wide margin to set domestic tax policy, and revenue collection in terms of the ability to raise revenue and, if you want, maximize the revenue collection at a global level. So to some extent, the issue is that we have sacrificed the later one, like on behalf of globalization and sovereignty. But if the opportunity is open, at the moment with the UN Tax Convention to change course, what can be done in terms of drawing conceptually, like the line between harmful tax competition and legitimate competition, as Ryan said? That's one first question. The second question is, taking into account this debate, like to what extent a static definition or a dynamic framework is required then in the convention, and procedurally, what are the options to address this, recognizing that the convention must be future-proofed? And then, what should be like the position regarding existing standards? Because if it is clear that it's not only an issue of minor fixes within the current frameworks, but that there are major problems that need to be reviewed, to what extent the need for approaches that align with the principles of the convention are needed in a way that introduces major reforms or the need for major changes regarding what current standards bring. So yeah, I would like to open the floor for an initial round around these or other critical issues that you think are important, while I have a chance to collect some of the questions from the chat. I don't know, maybe we can go in the opposite order. So Ryan, if you would like to start, please.
Sure. Thank you. Thank you, Sergio. And I would like to tackle the legitimate tax competition question, and how that should be framed. Certainly, I think based on my contribution, I certainly object to by default defining countries as harmful by the function of their internal domestic tax policy. And tax incentives, like I said, are universal. They're not something that countries like the Bahamas have created. I think when it comes down to it, I think we do believe in tax compliance in the Bahamas, and we do believe that the global tax transparency is a fair approach. And I think the definition of a illegitimate form of tax competition would be one that has at its sole core the focus of tax evasion, rather than I would say tax avoidance or tax competition or tax mitigation. I think those are two clear distinctions that define what is a legitimate tax competition and what might be illegitimate tax competition. So the distinction is really the concerted effort to encourage tax evasion as compared to tax mitigation. And I think that would be a fair standard on defining what is an effective tax incentive.
Thank you so much for that answer. That opens a lot of questions in my head, because in any case, like the mechanisms to assess concerted tax effort for those purposes will require like an assessment made by whom, like things like that it's important to
but we get assessed all the time. We have OECD peer assessments all the time. I'm sure we would have assessments by Conference of Parties through the convention. We have CFATF here assessing us all the time. We have our fifth round mutual evaluation later this year. So we live in a world of assessment. So I don't think that having an assessment that has really a true purpose would really bother us.
Thank you so much. Also, like one question, but also just to for the purpose of discussion is that if this sort of threshold based on a concerted effort uh, will be suitable enough to cover the fact that even sometimes when there is not concerted effort, there can be unintended consequences that reduce the overall global tax collection, like as a result of some practices or policies. But of course, this is for conversation. If what's the threshold and the sufficient requirement for trying to cover and tackle a definition of harmful tax practices that different actors can have in mind. Of course, we can come back to this in case you would like to comment later, Ryan. But also, I would like to open the floor for Marlene to also provide some general comments on this initial set of questions when we move to the questions from the audience.
Yeah. I let me just say that Jamaica is not opposed to countries having policies which we support tax competition. But as a country that has been impacted by harmful practices, particularly through a regional treaty that we have, I have to say that we would support any initiative and but let me just qualify that by saying that we do have several concerns about how the Forum for Harmful Tax Practices carries out its what I would refer to as a kind of inequitable way of applying the outcomes of their deliberations. Certainly, we think that the whole process of blacklisting is egregious. We believe that it is non-transparent. We believe that it is done in such a way that really deprives countries of their dignity to some respect. Right? You could just wake up one morning and hear that you are on a blacklist, which has happened to us. We're not a financial services country. Jamaica has a very high tax to GDP rate at about 27% to GDP. We do have a small incentive regime, mainly focused around the special economic zone, but we got rid of our incentives in around and about 2015 because we had found them to be non-productive. And so we changed the way in which we try to stimulate investment. Now, having said that, I do believe that there, in looking at the at Article 8 and within the context of what we hope to be a really revolutionary change in how the current system operates, right? I do believe that nevertheless, there is need, and I think Ryan also endorsed this, there is need for the convention, for Article 8 to set out what do we consider to be harmful tax practices. I think there has to be a working definition. I do not believe that Article 8 currently leads in that direction. And what Article 8 says is that the state parties are to cooperate to identify and determine harmful tax practices. So that leaves it up to the state parties to make a determination about what actually constitute harmful tax practices. So in other words, that the counter to that is to use the current FHTP definition of substance and also using the tools that they use to determine the way in which they measure the harmful tax practices and determine whether or not they are base erosionary, which is the core of what they consider to be harmful, whether there's a lack of transparency and so on. So states will be asked to first cooperate to identify and deter harmful tax practices. So there's no definition per se as what is a harmful tax practice. So if you're cooperating to identify and deter, then what are you cooperating and to deter when you do not have a definition of what is a harmful tax practice? Will that be led up to the conference of parties? Then there in Article 8, there should be international and regional collaboration to neutralize the distortive effects. So here is what we know from Article 8. We know that there should be the deterrence. We know that there are distortive effects in harmful tax practices. Okay, so where there is harm, what the state parties are to do is to cooperate to identify them, and that there should be regional and international collaboration to neutralize them. Okay, and then there should be the strengthening of each country's ability to tax income in line with domestic laws and practices. That line recognizes what Ryan has been speaking about, which is a sovereign right of countries to implement policies, so incentive policies and so on. So what would I call it now? What I take away from this first part of Article A, right, is that countries are to maintain their sovereignty. They are free to introduce policies that will bring about the stimulation of their economies, and they are which includes incentives. However, those policies should not be harmful, right? And they are calling up on state parties to collaborate to neutralize the distortive effects of such policies. Part 2 of Article 8 now speaks about what are the tools that will be relied on. The development and enhancement, it says, of effective tools, and they don't particularly set out what the tools should be, but we have some hint of what they are supposed to do. They should provide enhanced transparency, enable monitoring and identification of emerging harmful tax practices. So it contemplates practices that are to come, and they should facilitate the effective taxation of activities which not facilitate the effect, well, facilitate, sorry, the effective taxation of activities benefiting from harmful tax practices. And if you look at, and while that is Article 8, if you look at what the African Tax Union has submitted, what India has submitted, and Norway, you will see some similarities around Article 8. India, I think, speak to what they refer to as a common set of principles, right? So India, I think, is somewhat in line with the need for us to have from the Framework Convention a common set of rules, a definition, in my view, of what constitutes a harmful tax practices, a harmful tax practice. And so I think that they need to wrap up my intervention to be able to, okay, so I got you, I heard you, right? And so therefore I believe that where we need to start, because as far as I'm concerned, what we are addressing is the gaps, right, that currently exist in the international tax system to address this issue. It is an issue, right? I think everybody will agree that where the policies are impacting other countries and eroding their tax base, and companies are getting away with not paying the right amount of taxes, I do not believe that anybody would believe that to be a fair tax system. However, I do believe that we need to look at Article 8 at filling those gaps. And certainly where we need to start is by having a working definition of what is a harmful tax practice.
Thank you so much, Marlene. And before passing the floor to Steven, I would like to remind for those that maybe need to leave earlier from the audience that as we are coming to close, we will appreciate if you can complete our short feedback survey that my colleague Caroline just shared in the chat box. But Steven, please, your reactions.
Thank you, Sergio. And again, thanks everybody for making today so helpful, I think, to so many people. I just watching the chat and the Q&A, people are really deeply engaged, asking great questions. I did want to make one so Ryan, I think, was a little too modest. Not only did his party win, they absolutely crushed the opposition, becoming the first party to have a second straight election victory in decades in the Bahamas. So, he just sort of threw in, hey, we won. They mopped up the competition. And I think that's a testimony to his leadership as Attorney General, not in a small part on this issue, which is very important to the country. So kudos to him and to his party for that victory. So I'm going to offer just a very short digression. So we talked about Pillar 2, but I think it's worth highlighting Pillar 1, right? So Pillar 1 was the other one of the proposals that the OECD made in 2021. And at the heart of Pillar 1 was a prohibition on what are called digital services taxes. So these are a new kind of tax introduced first in France, spread all over the world as a way of taxing these giant digital companies that are not being taxed anywhere because of a system set up by the OECD in the US. And Pillar 1 was essentially a way to sign on to this agreement, you had to agree not to impose the digital services tax. And I cannot imagine a more harmful tax practice than preventing states around the world from taxing these incredibly profitable, powerful companies as if they needed somebody to look out for them to make sure rapacious countries like Kenya and Ghana were not going to put them out of business by imposing a digital service tax. I don't really understand it. But just understanding what we're focusing on and fighting about, the terrain that we're being directed towards, unfortunately, is being driven by a debate shaped long before countries like the Bahamas and Jamaica had a voice in this. So, when somebody in the chat says, is it not having an income tax a harmful tax practice? Inevitably, yeah. I mean, in a way, it's one of those questions you can't avoid answering in a way that's contorted. But that's because the debate is so far gone that the OECD can propose a ban on a new kind of tax and almost nobody notices. So I know that we're out of time and want to leave as much time for other folks, but I do want to mention those two things.
Thank you so much, Steven. And yeah, just to maybe encapsulate the questions that we are having in our Q&A in three segments and allow each of you to speak for 2 minutes before closing. I will summarize them as well. Some conceptual questions, including Maria Paula's, Nessa, and or anonymous attendee that asked a couple of questions in the chat, because they touch upon the first of all, like differential treatment, and if it is really needed, and that connects with the point that you were mentioning, Stephen, like to have like the same kind of standards when we realize that we come from different stories in terms of responsibility, but also contributions that are required to according to level of development and other considerations from actors within this field. So to what extent, avoiding harmful tax competition should be like as a standard that applies the same for all groups of countries. That's along the lines of what Maria Paula is asking. Also, Nessa is speaking about, the pitfalls of the concept of tax sovereignty and its abuses, how to prevent those abuses. A second set of questions speaks about the role of the US, particularly Brita, that is mentioning if to some extent the US exit from the OECD minimum tax and the fact that many countries have introduced pro forma minimum taxes and complex implementation challenge to some extent has created a lot of administration challenges that made this approach die before it was really born. What's your view on the matter? And then we have another group of questions that connects more with the role of tax transparency in addressing this problem, and how reforms within the UN that are ongoing beyond the UN Tax Convention discussions also can reinforce or limit some of the transformations that the UN Tax Convention can bring. So we can go again in a reverse order, starting with Steven for 2 minutes before closing. Thank you so much, Steven. Yeah.
Sure. Thank you. And again, I'm just so blown away by these the questions and comments. And again, I've been working in international tax for more than 2 decades, and it's impossible to overstate how different the conversation is now than it was 10, 20 years ago. How much richer it is, how much more informed it is. When I see questions in the chat, like Maria Paula's question, why are we talking about harmful tax competition? We should be talking about principles like distributive justice, right? Yes, 100%. And that's what are we talking about, right? It just the debate has been so narrowly constrained that we lose the bigger picture, right? When we end up with we end up with economic sanctions being imposed on a country in the middle of a civil war because they don't have an income tax, we're doing something wrong. Like we're just lost. We're lost. And I think the conversation that's happening today, the engagement from folks in the chat that I'm seeing, means that we're getting a little closer to being found. And I don't think there are easy answers, but I think it's an important conversation. And it's just so wonderful to see it happening. And I'm getting chills just appreciating how far this has come and how optimistic I am for how things could continue. So thank you to everybody for your engagement here today.
Thank you, Steven, for that note on optimism and enthusiasm with the process. Marlene, please, for 2 minutes. Yeah.
Okay. Well, I think I think the discussion has really stimulated a lot of reflections that I think we probably need to take into consideration in discussing not only the issue of harmful tax practices, but certainly we also have to consider the article that deals with exchange of information, and the other administrative cooperation across borders, articles that will be in the framework convention, and how they all come together to form a coherent framework in which because it is all linked. The fair allocation of taxing rights, for example, is not far away from this discussion that we're having on harmful tax practices, because you have to discuss, well, what is fair? And so I think the discussion, I think, has stimulated, I think, food for thought. I think that I will certainly take away from this information that will inform Jamaica's own input on this question of harmful tax practices, as well as other articles in the framework convention.
Thank you so much, Marlene. And now I will give the floor to Ryan for final.
Thank you. Thank you, Sergio. Just briefly, I mean, I think that really, and then I want to take up the question on Pillar 2 and the query about the U.S. and where we are. This all comes back to the predicate that non-member small states in the OECD put forward, that we would participate on a level playing field. And throughout history, the OECD has demonstrated that it does not believe in a level playing field. And I gave some examples of that. FATCA was an example of that, certainly where the US was not compliant with CRS, yet they were given an implicit approval by the OECD, go ahead and have a form of tax arbitrage when it came to transparency initiatives. There's no different with Pillar 2. Where the OECD is providing the same exemption to countries like the United States, and now negotiating with China and other large trading partners about having a differentiated treatment than the rest of the world when it comes to a minimum corporate income tax. And this is really what breaks down the viability of international tax regulation by a small members club to the exclusion of others, and then negotiating what we call side letters and side agreements with their members to give them a preferential position vis-a-vis the countries that they think are really the harmful ones, and creating inherent and unequal tax competition to benefit their members as opposed to those who are non-members. And so nothing has really changed. And if the OECD wants to push through these requirements, so long as we tolerate unilateral sanctioning such as blacklists, and so long as we water down and create discourse within the United Nations, this will not change. And that's why we have to be a little bit more aggressive, a little bit more unified, and push the envelope in forums such as the United Nations to actually achieve a level playing field that we all want, and achieve tax equity between all countries. And so I still see it as much of the same, but we have to be a lot more, I think, aggressive, and we can't allow ourselves to be pulled apart by the global north when it comes to these negotiations.
Thank you very much to our panelists for such a rich and timely discussion. Today's conversation has shown that harmful tax practices are not merely a technical question about preferential regimes. They go to the heart of international tax cooperation. Who defines harm, whose tax base is protected, whose sovereignty matters, how to create a truly level playing field, and how the international community distinguishes legitimate policy space from harmful spillovers. The UN Tax Convention process offers a historic opportunity not simply to inherit existing standards, but to ask whether they are adequate, legitimate, and effective for all countries, and build a future-proof, universal, and inclusive framework. On behalf of the Tax Justice Network, thank you to Professor Stephen Dean, Ms. Marlene Nembar-Parker, and Leo Ryan Pinder for joining us today. Thank you also to everyone who participated and submitted questions. We warmly invite you to join the next sessions in this series, where we will continue unpacking the contested definitions that will shape the future UN Tax Convention. Tomorrow, we will have, at the same time, a wonderful lineup in a session moderated by my colleague Bob Mitchell on foreseeable relevance, a key concept for the exchange of information discussions in the convention. Thank you very much, and we look forward to continuing this conversation.